Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. That I have noticed from previous podcasts is I've seen you talk a lot about finding areas where the variance risk premium is overpriced. And for anyone listening who doesn't know what the variance risk premium is, it's the tendency of implied volatility to be overpriced compared to realized volatility. So can you go into detail about how you find these overpriced risk premiums?
Well, I think more important than going into it in detail is going into it generally. I think the thing you have to realize with a risk premium is it's right there in the name, it's risk. So you have to look for situations where there are obvious sources of risk and then decide if they're fairly priced or not. So in order to collect the risk premium, you have to take some damn risk. And a lot of people don't really want to, which is exactly the reason it tends to be there. So look for situations where you are most nervous about doing the trade. So for example, there's a very well-known risk premium, and I'll tell you this because you can't really make any money out of it. Most of the decay in options, so most of the variance premium is realized overnight. So it's realized in those times where you can't hedge. It's realized in the time when you're exposed to jumps. So a lot of traders would love to be long overnight and short during the day. And because a lot of people want to do that, there's no money doing that. That's exactly the wrong thing to do. So you have to really look, if you're nervous about going into a situation, that's when there might be a variance premium. I mean, there might not be. I mean, the ultimate thing to do is test it. You know, it's easy to come up with lots of reasons for why things might be true or should be true. But ultimately it comes down to, you know, looking at some numbers and seeing if it would have worked.
Could you go sort of more into the details about how you find these premiums?
Well, that's pretty much it, actually. It's you find a situation where people might be nervous. So for example, I don't know, the election. You've got a situation that is uncertain. And when there's a situation that's uncertain, people are going to be nervous about it. And as a result, the implied volatility is going to get very high. And then you have to go and look for similar situations in the past and see what happened. I mean, it could be that options are cheap before elections. I mean, they're not, but that could have been true. That's not intrinsically impossible. So after you've come up with these things, really the only thing to do is look at some data. I mean, theory and supposition only go so far. Eventually, you've got to look at some numbers.
That is true. And, you know, it might be a naive belief that once you find an inefficiency, it is easy to make money. So could you give us an example of an inefficiency that you've traded in the past and what it took to actually extract money from the markets?
Well, honestly, most of the things I trade aren't inefficiencies. I would say that a risk premium is not really an inefficiency. Say an inefficiency is literally something that someone hasn't noticed. Whereas the risk premium, everyone's noticed it. It's the wrong price. So I just wanted to make that point. But having said that, if you look at a situation like, I don't know, 2016, 2017, the volatility in the market was really low. And the implied volatility was much higher, as is often the case. You know, when people think that when vol's low, it's a good time to buy options. And that's completely the wrong way around. When vol's low, it's almost always a good time to sell them. So I think, just off the top of my head, the VIX was around, I don't know, 10, 12, and the realized vol was something like 6. So that's like an enormous volatility premium. The problem is, if you do that through options, because it's a low volatility, the options have high gamma. So you've got to do a lot of hedges. And once you do a lot of hedges, you've got a lot of path dependency. So It's a situation where in advance you think there's an edge. Subsequently, if you just look at the vols, you will see that there was an edge, but it's not trivial to get it, because depending on exactly how the underlying moved, you may or may not have made money. Whereas if volatility is, so there was an example where you might have had a 50% volatility premium, but if volatility is 30 and the subsequent realized is only, I don't know, 25, so the percentage volatility premium is much lower, that's actually a much easier premium to get because there's a lot less gamma associated with it. So monetizing things is different from recognizing them, particularly in options, because there's all those path dependency and hedging effects, which you don't get. And if you're trading a stock and you think it's going up, well, you buy the stock. And if you were right and it went up, you'll make money. Which is interesting, actually, because that's a case where making money is easy. So finding those opportunities is hard. Whereas with options, it's actually fairly easy to identify some of these issues. It's easy to find the trade. It's just hard to monetize the trade.